back to school month has weighed on Kenya. In January, the East African nation's inflation quickened to 6.9% from 6.6% previously. This as the higher costs for school fees, power, fuel, and clothing exerted more pressure on foodstuff. Now, Ridle Markus, who's Sub-Saharan Africa Macroeconomist at Absa CIB, joins us with his analysis of this print. Ridle, always a pleasure. Good afternoon.
Good afternoon, Erican.
Let's touch on this inflation print for January. 6.9%. Help us to contextualize it.
Well, firstly, I think the 6.9% was slightly softer than what we thought. We thought 7%. January is always a high inflation month or a high survey month. So 6.9%, definitely higher than the previous month's 6.6%. Not great, but still within the target, inflation target, which has an upper limit of about 7.5%. So I don't think anyone will probably be too worried. But at the same time, you don't want to see inflation going up. Looking at some of the drivers, the underlying drivers of the inflation rate, we see that the higher electricity charge that came into effect from the beginning of this month, education costs, tuition costs, etc., all played a role in driving inflation higher. And I think the month-to-month rate in the CPI, or the increase thereof, was around 0.4%. So not great, but I don't think all is lost. We did see the currency come off a little bit in the past couple of weeks. So we're hoping that the inflationary pressures will start to subside should the currency strengthen further, or even if it just remains at current levels. But the reality is, of course, that we've already seen global oil prices ticking higher. There's a lot of risks, geopolitical tensions globally. There's weather-related risk in East Africa as well. So no guarantees, but I think we are of the view that inflation is probably not too far from peaking, and we should see a downtrend over the next year.
I'm glad you mentioned the issue of climate change. We have seen Kenya really, suffering the consequence of that. What are we seeing in this print, especially how it's, affecting their food price inflation?
Yeah, so food prices have definitely been a topical issue for Kenya for a while, and especially I think in the past couple of months. I think since late last year, we had the El Nino effect. We had above average rainfall in the area. But I don't think the food prices have come through as strong as we would have thought initially. There is a risk, of course, that the El Nino impact will continue into at least the first half of this year. So we'll have to see how food prices go. And then, of course, there's the international impact of food prices. The currency, as I said, is already weaker. It did strengthen in the past couple of weeks. But on a year-on-year basis, the currency, I think, is over 23% weaker. So we'll have to see how the currency trajectory goes, how international food prices goes, how the weather condition locally go, and whether that disrupt, cash crops especially, before we get too optimistic about the food price trajectory that we've just seen, which is, as I said, slightly softer than we would have anticipated previously.
I think we are seeing, Ridles, that even the decline of inflation globally, it's not an even picture, it's not a straight line. And so what we're seeing in Kenya right now, nothing to be overly concerned about.
So you're right. I mean, when we think about the outlook for, especially like the currency, we think that there is potential weakness still, but that we probably have seen the worst of the adjustment in the currency already. So the currency is probably not going to be the same kind of driver as we saw last year. There are a couple of unknowns which I've already mentioned, but we think that after inflation averaged 7.7% last year in Kenya, that it can probably average around 5.5% this year. So there's definitely reason to be optimistic. In fact, our year-end number for inflation is around 5%. So basically the midpoint of the target range. And therefore, we don't necessarily expect the central bank to hike the policy rate further. Recall that we just saw early December last year, 200 basis point hike in the policy rate. And I think that tighter monetary policy in part was obviously to support the currency, but also to re-anchor inflation expectations. So the tighter monetary policy should also play a role in helping to contain not just the inflation expectation, but obviously inflation overall. So generally over the next, 11 months up to the end, we think inflation could start to edge lower.
The global conversation is around interest rate cuts at some point, and also, emerging markets like us really trying to protect our currencies as we consider these cuts. What does Kenya's picture look like where cuts are concerned?
I do think that talking about the global rate cuts, I mean, there's the potential that those will be beneficial for the local currencies. I do think, though, that in Kenya's case, there's still a concern around how they're going to refinance the 2024 Eurobond. They need to come up with $2 billion. But should they, reveal how they're going to do it and pay that Eurobond, I think there's probably a bit less risk in the second half of the year on the currency. And with that in mind, and if, adverse weather conditions or weather conditions at least stabilize, we could see potentially a cut in the policy rate deeper into the year. I think at 12% and above, the policy rate is fairly steep, but we could see, as I said, there is potentially room with inflation coming down to 5% by the end of the year for them to cut the policy rate, just providing some relief to consumers.
Well, Ridle, always a pleasure hearing from you. Thank you so much for taking us through Kenya's inflation trajectory. That was Ridle Markus, Sub-Saharan Africa macroeconomist at Absa CIB.